The market was so hot in the past 10 years or so that if you weren't crushing your projections, there's probably something wrong. And so we like to see sponsors that are significantly outperforming.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right. Welcome back, everybody, to the Freedom Point Real Estate Podcast. I'm your host, Jeremy Dyer. Glad that you're back with us again today. I have a very exciting guest with me today, Elijah. Elijah is the co-founder and managing partner of GoldHawk Capital, which is a multifamily fund of funds company with interest in over 1,000 doors valued at over $150 million. So quite an extensive background, quite an extensive portfolio of investments that Elijah's involved with. Elijah, how did I do on the intro? Do you have anything more to add?
Oh, you're too kind. Thanks so much for having me on. I'm really looking forward to this chat. This isn't our first conversation, so I am 100% sure that it's going to be very interesting because our last chat was awesome. So thanks for having me on.
Yeah, I appreciate it. And I've not known Elijah for a very long time, but we connected several weeks ago. We're both in a very similar space here in the real estate business. So very much doing some similar activities, similar goals, similar focus, and thought it would be great to have Elijah on the phone here to ask him some questions about his background, as well as to dive in deep to some of the passive real estate strategies and things that Elijah has learned in that space. So that said, before we get into some of the meat and potatoes here, I gotta disclose this to my audience. Elijah and his wife, right?
Girlfriend,
soon to be wife, right?
She keeps asking.
My wife gave me the 5-year ultimatum. So once you get to that point, it's probably time to pull the trigger. But I got to tell the audience, Elijah and his girlfriend live in an RV in the Denver area. So Elijah, can you tell the audience just a little bit more about what you're doing there?
Sure. And actually, we don't live in the Denver area. We're in rural Colorado, but we travel full time. We decided to do this about 3 years ago. We had a bunch of our real estate deals go full cycle. And with some of that money, we decided to make a lifestyle change, and we bought a Mercedes Sprinter van, and we spent 2 years building it out. Brutal process. I don't recommend doing it yourself unless you really want that challenge. And it took us 2 years, and we finished it up, and we've been on the road now full time for the majority of this year. We've been down to Mexico, we've been to Arizona, Vermont, South Carolina, Colorado, and we're just having a good time.
That's awesome. I hear more and more from other people that are able to pull off this kind of work-life pleasure balance while living inside of an RV. I also own an RV, and between my family and myself, we've traveled the country, including Canada. But I've only been able to pull that off for maybe a 1 to 2 week stint at a time before I feel like I've got to get back to the mothership again. So Sure. Amazing that you guys are able to pull off living in an RV full time. I think that's just incredibly awesome that you're able to do that. The other side of it for me is I've got 4 children that are actively involved in all their various sports and activities. Sure. So for me to pull them away from those activities, full time would be a bit of a challenge at this point in my life. But thank you for sharing that. I appreciate it.
Absolutely. Starlink satellite really made it all possible. And we do see families on the road. Now they're all homeschooled, and it's obviously a challenge to come up with activities and social engagement for them, but we see it all the time. Usually they roll up in a 40-foot school bus. So it's not off the table for you.
Sounds good. Sounds good. Well, our RV is 40 feet in length.
There
It
you
is not
go.
a school, it's not a school bus, but we do homeschool our children. So we do have
Oh,
that in common.
so
So,
there you go. You guys can go take long trips.
yep, absolutely.
Cool.
Well, good. Well, you mentioned something earlier on about how you were able to have this type of lifestyle, right?
Yeah.
There was an exit on the W-2. There was an exit from corporate America, and there was this pivot that you made. And you're not even. I mean, I'm 44 today, so I just, in full disclosure, it is my birthday today. Okay.
Happy birthday. I had no idea.
Thank you. You can sing happy birthday at the end of the call.
You're
So I
working on
turned,
your birthday.
well, I had to fit this in, Elijah,
Appreciate it.
of course. So at any rate, I think I'm a little bit older than you, maybe a decade or more older than you. And many investors that I talk to that are around my same age, they all want to pull off this kind of replacement, of the W-2, the dependence on the W-2. They want to pivot, their lifestyle in a different way, so they're not so dependent on actively earning income. So, can you walk through your journey of actively earning income to now being at a point in your life where you're able to sustain your lifestyle while off of your passive income?
Yeah, absolutely. It actually started before the W-2. So I was in college watching a lot of YouTube videos, learned about rental properties, and realized that it was the best possible thing I could possibly invest in. And I got together with my cousin and my best friend, and we started buying single family rental properties in Orlando, Florida. Essentially, we were just going and finding like $150,000 homes, doing very basic renovations to them, hiring people to do this, obviously, because we were living out of state, and putting tenants in and just sitting on them. And so we did this a bunch of times. I then ended up getting a job right out of school at a real estate fund. So I knew I wanted to go into real estate. Wasn't really interested in working for money. So I was really excited by the opportunity to go and work for this company so I could learn something and spend a number of years learning what I needed to do to become successful. So I stayed there for 4 years. And meanwhile, on the nights and weekends, I was getting together with my coworkers and putting together these small multifamily deals, like 4 to 10 unit deals. I did a number of those, and I was doing all the work, pretty much finding properties, finding contractors, property managers, organizing the debt and the equity, doing literally everything. And it was brutal, and I burned out and realized that if I really wanted to scale the portfolio and do this long term, I needed to focus on what I was good at and passionate at, and essentially outsource the rest of it. And so I discovered partnerships, co-GPs, or whatever you want to call it, where I would go and I would find a much larger company that was putting together a really solid deal. And then I would offer my services. What I was good at was underwriting and investor relations. And I would add those values to their deal in exchange for some of the fees. And doing that allowed me to exponentially grow the portfolio from, less than 20 units to, now over 1,000. So that's where I'm at now. My business has completely pivoted from actively managing these deals by myself to essentially due diligence and capital raising for much larger opportunities with companies such as Rise 48 and a few of the other sponsors. So that's where I'm at now.
So I think if I'm hearing you correctly, you were very much in real estate at a young age. You did this single family, maybe fix and flip. You had tenants, those types of things. You made income on the active side. You saw that you could scale up. And so you did that, and you moved into your fourplexes, your 10-unit apartment buildings, but you were all still doing that on the active side.
Yes.
And then what happened between that point and the point where you're like throwing your hands up in the air saying, I'm getting out of the active, game of managing real estate fix and flips and small multifamily, apartment communities, and getting instead into these large 100, 200 plus apartment communities, and doing it still on an active side? I mean, you're still on the active side in a way. You're just not the guy swinging the hammers on the weekends. Am I saying that right?
Completely different business model. But yes, and there were a few different things that kind of made me make that transition. The first one was that, I got into this in the beginning because I wanted passive income. There's absolutely nothing passive about actively managing an apartment building. It's a full-time job. It's brutal. Every single day there are just a million roadblocks and setbacks and phone calls about mold and water and bad tenants and fires and every little thing that you could possibly imagine. And it's exhausting, and it caused me a lot of anxiety. And I was very lucky that all my deals that went full cycle did very well. We hit, between 30% and 160% IRRs on these deals. And so, they worked out well, and I was able to sell a bunch at the top of the market. And I just really wanted a change of lifestyle. I realized that I could not sustain this moving forward. It's just way too much work, and I had to do something different. That was around the time when I started, having the idea about getting a van or a bus and traveling full time, and essentially doing that remotely, working remotely. And I decided to make the switch from doing the active stuff to just doing the passive stuff. I had made a little bit of money selling those deals, taking my split of the profits from that, and I was able to repurpose that money into a lot of these passive deals. That's number one. The second part of that whole thing was I realized that I get the best bang for my buck raising money. And so I make the most amount of money for the amount of time I spend when I am in an investor relations role. So, typical, like a broker will make, maybe 3% on a sale of a property. A debt broker will get 1% of the purchase price. A yacht broker will make 10%. Same thing with like a jet broker. On the equity raising side, we're making between 10 and 20, sometimes even 30% of the money that we raise in fees over the course of the investment. And obviously, a very small percentage of that is on the front end, and almost all of it's on the back end when the deal goes well. But there's just a lot more reward for the amount of time that's put in. And so I decided I'm going to focus on that. It's something I can do remotely with a Starlink satellite from BLM land in the middle of Mexico, or middle of nowhere, or in Mexico, or wherever I want to be. And essentially, my business became a sales, marketing, and investor relations business more than a real estate company.
Interesting. I appreciate you sharing that with the audience. So you had mentioned earlier the name Rise 48. I obviously know Rise 48 as an investment sponsor, very popular in the Phoenix and Dallas markets. There's obviously other sponsors out there, I'm sure, that you're helping raise funds for as well. But my question along those lines is how does Elijah and your firm, how do you go about evaluating and vetting sponsors that you feel comfortable enough raising private investor capital for?
Yeah, and it's kind of a long process, and it usually starts with me doing some kind of test investment with my own money first. But it really starts out with, meeting these people at a conference, for example, the Best Ever Conference or one of the other conferences, or just interacting with them on LinkedIn or hearing through the grapevine about these sponsors from other investors. And then I start a multi-year process of following them in their deals. So it's usually, a few years of me watching their communications and their deals before I'll even, consider making an introduction and taking a look at their deals myself. I then have a ton of criteria that I need my sponsors to meet. For example, like with a Rise 48 situation, I want to see 5 to 10 or more full cycle deals with IRRs that are significantly beating projections, and we got that with them. Same with a lot of other sponsors. My thought on that is that the market was so hot in the past 10 years or so that if you weren't crushing your projections, there's probably something wrong with the way that you're managing the deal. And so we like to see sponsors that are significantly outperforming. I also don't want sponsors who are going to do capital calls. What that means for those who are listening is something goes wrong. maybe the cap on the interest rate expires, or there's a massive capital issue at the property, and essentially there's not enough money to pay for it. Well, the option for the sponsor is to either go to the investors and ask for more cash. They could declare bankruptcy, or give keys back to the bank, or if the sponsor is wealthy enough, and they could write a check to save the day and save the deal. So I want someone who's going to come in and save the day before they ask me for money. So that's another criteria that I look for. There's a whole bunch. I, being a finance guy from an underwriting background, I was an analyst at a major REIT. I like to take a look at the underwriting model and make sure that it's conservative enough for me and for my investors. And so those are just a few of the things that I look for. But it's a multi-year process, because I really need to trust these people if I'm going to be investing with other people's cash.
Yeah, it's a tremendous fiduciary responsibility, when you're in a role like you're in, where you're encouraging your investors and your investor network to partner alongside you, in these opportunities. So that's a tremendous responsibility, right? To make sure that you're properly vetting out, those sponsors that you're willing to work with, and ultimately those actual investment opportunities that you're then bringing to your investor network. So thank you for that. I also appreciate you explaining to the audience what a capital call is and the potential of such an occurrence to happen. I think that's incredibly important. And I don't want to dismiss the fact that maybe people listening to this particular episode are familiar with something that you said, and that was the acronym of an IRR. I know that you're maybe not going to break down exactly how that IRR is calculated, but most investors are familiar with the annual rate of return. Yeah. What would be the major difference or two between the annual rate of return versus the internal rate of return?
Yeah, when you're looking at an investment opportunity on a multi-year horizon, the rate of return is not just it doesn't just go up in a fixed amount every year. There's something called compounding interest. It's the eighth wonder of the world. And so if you take a look at a dollar and you make 10% every year, well, it doesn't just go up linearly. It actually goes up exponentially, because that dollar then becomes $1.10, but then the next is not just 10 cents, it's 10 point something cents. And so every year you're adding more and more because of compound interest. And so the IRR essentially just works backwards. It pretty much says, what does that annual rate of return need to be to reach a certain dollar amount in the future, taking into consideration that time value of money with the compound interest. So it's not just a flat, we're going up 18% every year. It's we're going up 15%, but then it exponentially goes up and reaches the same ending future value. That was kind of complicated. To make it really simple, it's the annual rate of return when you factor in the time value of money, essentially the compounding of those cash flows.
Yeah, it's a great explanation. Thank you for that. For those listening to this, if you want to find out what the equation looks like, go to Google and then try to explain that to somebody. So totally get it. It's a really tough question. Thank you for taking that. That was a hard question, not a meatball one.
There are more complicated answers to that. I tried to keep it as simple as possible. You could explain it as the discount rate that makes the net present value equal to zero, or whatever. There's a lot of different ways that finance geeks describe it.
Yeah, no, that was a great summary. So I appreciate you sharing that with the audience. So since you've got a lot of experience, as a passive investor, you have experience, obviously, evaluating sponsors. What are some questions that a potential passive investor, or maybe a passive investor that has invested previously before, what are some questions maybe that individual should be asking of somebody either like yourself that's helping raise funds for these opportunities, or if they're going direct to the sponsor, what would be some common questions that you think my audience should be asking before they make that decision to send in that wire transfer for their investment?
I think at the core of like the actual investment itself, you should understand the assumptions that are being made to arrive at those return profiles. The reality is
What are
that
some of those assumptions, right?
yeah, and before I get into that, every company calculates things differently. A 15% rate of return might be an 18% from someone else, and so the assumptions that we're looking at, simple things like how much are you going to increase rents every year? Like, what is your assumption for that? What is your assumption for, once you've renovated a unit, where the rents are going to go? What are you going to sell the property for in 5 years? That's a big one. It's like, and we value properties based on cap rates, but it really just comes down to like, what's the price you're going to sell it for at the end? Because that's the biggest needle mover in all of it. If you're coming to me and telling me right now you're going to sell a property at a 4 cap, which means an insanely high valuation, I'm going to laugh you out of the room and say like, okay, that's not conservative. I can't present that to my investors. So, we call that exit cap rate or sale price. That's a huge lever. I want to know about the debt. Once you've renovated and the property is stable and leased up, how much cash flow is coming in, and will that cash flow be able to service the debt with, a margin? We call this the debt service coverage, or the debt DSCR, if you've heard of that. And I want to know what it's cash flowing out right now. What if something happens with the renovation plan? Will you guys be able to hang on and figure out how to see it through an economic recession just with the cash flow that you have? These are all important questions. Things that I think that people kind of overlook or don't really understand is, the actual like partnership economics. What I mean by that is how much of the profit is the sponsor going to take at the end of the deal? Are they going to start taking that profit right away in year one, once you've hit, a certain rate of return? These are important questions to ask. What are the fees? How do those fees compare to other sponsors that are charging fees? Is this actually like a fair deal? Something else, I'm interested in the going in basis. What that means is like, how much is the sponsor actually going to be paying for that property, and is that a good price or not? We can look at that based on the market cap rate. We can look to see if, is that a discount based on where the listing price was at. There's a lot of different factors involved. And I'm glad you brought this up, because this is why it's so important to work with someone like Jeremy or myself, because we've been doing this for years. Like, I've been doing this for over 7 years. Jeremy's probably been doing this for 50 years. And
Wait a second.
but we've been around the block. We've seen every deck, every possible, underwriting model. We know what to look for, and the 100+ red flags that are out there. And, this is something that we can, identify in advance and advise our investors on. Is this a good deal or is it a bad deal?
That's great. Thank you for that summary. I was just going to add one more item to your assumptions, and that's on the expense side, right?
Yeah.
Which is by and large why I personally like to invest with sponsors that are vertically integrated on the construction management side and on the property management side. Because let's be honest, the inflation monster has hit a lot of people, in the last couple of years, and it's not going away. It might get tamed down, but at the end of the day, it's still not going away. Material costs are going up, labor costs are going up, right? Insurance costs are going up. So all of those factors create, an environment for a lot of sponsors where, we can force the rent growth, okay, through a reposition effort. But are we able to force the ROI? Because if our expenses are increasing at the same rate that our rental income is increasing, that can have a huge impact, upon what you mentioned as the exit cap rate. I don't want to assume that my audience understands what a cap rate is. Many people hear about the going in cap rate. They hear about the exit cap rate, right? Can you explain for the audience kind of the difference of the going in cap rate versus the exit cap rate, and then how forcing appreciation and increasing the ROI, how that has a positive impact on the exit cap rate?
Yeah, absolutely. And there's a lot. So there's a lot of different types of cap rates. You have the going in, you got the exit, you got a yield on cost, and I'll go over all this. It's all calculated the same. You take the net operating income, which is supposed to be reflective of the normalized ongoing, cash revenues minus cash expenses, not including the mortgage payment of the property, on a monthly basis or an annual basis. It's supposed to reflect like the normal operations. So you don't have things in there like large capital expenditures. You don't have things in there like the debt. It's just what is the regular cash flow happening at the property. And you take that number and you divide it by a percentage. And in every other business line in the world, we use a multiple. So it's kind of weird that we do a percentage. Like if you look at a company, you're going to value it by taking the EBITDA and multiply it by a multiple, like 3, a 5x, a 10x. In tech company, it could be a 50x, who knows? In real estate, we just do the same thing, but we divide by a percentage. It's the same thing. It's pretty much saying what is the ongoing normal cash flows of the property as a percentage of the purchase price of that property or the valuation. And on day one, you use the purchase price. You take what's the historical net operating income of that property divided by the purchase price. Maybe that's a 4 cap, a 5 cap, 4%, 5%, 6%. The higher the percentage, the more income there's being generated per dollar of purchase price. And so, we see a lot of deals right now in some of these hot markets like Phoenix and Dallas and a few other places with low cap rates because people are willing to buy an asset and take less cash flow for what they're paying. Whereas you go to more tertiary markets, like where I'm from in Vermont, people are willing to pay way, way less for that same amount of cash flow. And it's all aligned with risk. So, you see a lower cap rate and you assume, oh, wow, this must be a less risky asset. That's why you see, A-class buildings have like much lower cap rates than C-class buildings. People are willing to take, different levels of risk for different quality buildings. Anyway, that's essentially going in cap rate. It's the historical net operating income divided by the purchase price that you're paying. And what a lot of people compare that to is what happens after renovations. Well, there's still a cap rate involved, and we call this a yield on cost, where you take the new net operating income, which is going to be a lot higher because you just renovated units, and you divide that by the purchase price. What's your yield on cost? And the difference between that yield on cost and the going in cap rate is what we call the spread. And so a lot of institutional players will just look at your value add deal in terms of, what's the yield on cost spread? What are we looking at? Are we going to get at least a 3% increase in that NOI divided by the purchase price? If not, maybe it's not as much of a value add as you thought. So that's yield on cost. It's like, what's your after renovated stabilized cash flow as a percentage of the purchase price that you paid?
I was just going to say, would you be willing to explain to the audience what increasing, let's just say that the property has 100 units, okay, for simplification purposes, what that potential market price of that asset could be by just increasing the monthly rental income by just $100 on a newly renovated 100 unit apartment.
Yeah, and I'm getting my calculator out. So
I'm pulling the finance out of Elijah. He said he's got a background in finance. We're holding him to it.
Let's increase rent by $1 across the board. Well, there's 100 units, and that's $1 per month. So that's 100. We're going to multiply that by 12. So then you got $1,200 in increase of NOI. And we're going to assume that there's no increase in expenses. It's just a $1 revenue increase. So now you've got a property that is bringing in $1,200 more every year. Wow, that's great. And so the way that we figure out how that impacts the valuation is by capping it or multiplying it by an EBITDA multiple or dividing by a cap rate percentage, which is how we do it in real estate. So we're going to take that $1,200, we're going to divide it by 0.05 for 5%. And we have just added $24,000 of value to that property for every $1 increase in the rents, which is insane. Now, companies like Rise and other things and what we look for is we want to see like $300 to $400 of increase. So you multiply, that $1 by 300, you got 100 units there in 12 months. That's $360,000 of increased NOI. You take that at a 5% cap rate, and you've just increased the value of your property by $7.2 million. That's the power of forcing appreciation. That's why we love multifamily and why we don't love single family. You can never do that in single family. It's just not valued the same. They're valued based on comparable properties that are selling in the neighborhood, not based on the actual income that comes in. So,
Elijah, thank you for breaking that down on the fly. He had no advanced warning that I was going to ask that question, so I
what I do
appreciate
all day long.
I'm all about throwing you the hard ones, right? The curveball, so to speak. But I get that. I get the question a lot. The reason why I was asking is I get the question a lot from investors. They say, well, Jeremy, we've seen a decrease in certain markets around the country on the growth of rental rates, right? You could take Phoenix as an example. Phoenix is at a tremendous run up, in rental rate increases over the course of the last several years. But the trailing 12 in Phoenix, I think, is a negative 4% right now. And you might say, well, that's a bad market to invest in. Well, it might not be a bad market to invest in if your underwriting is not tied directly to natural appreciation or organic appreciation in that market, but rather it's tied to what you just mentioned, and that is forcing appreciation through a value add business plan. So thank you for sharing.
And here's a novel concept when you're going to underwrite your own deals. Like, just assume that there's no appreciation at all. Now, we all know that's not true. We invest in this because of appreciation. And whether CPI is at 1% or 8%, that's still appreciation. But let's just when you go to underwrite your deal, put in no appreciation and just base your increase in valuation off of increased income. And that's it. And that is a more conservative way to do it. And that's one of the things I look for with my operators. Like, I don't want to see a 5 or a 6%, market appreciation in the rents. I want to see a 0, 1, 2, 3%, annual appreciation or just none at all. And I want the whole deal to just be based off marking units to market based on renovations or management play.
Yeah, great point. Appreciate you sharing that. And there's really, quite frankly, there's really opportunities, for sponsors in different markets around the country to purchase assets at really any stage of the economic market cycle that we're in. Some markets are in a recessionary type environment, whereas others are in a hyper supply, or others might be in that expansion phase. But there's really those types of opportunities to force appreciation. So my question for you is this: I think I'm correct in saying this, so correct me if I'm wrong, but you are a large supporter of investing your own money into and encouraging investors to partner with you in investing in value add multifamily with as short of a time frame as possible, rather than investing in the buy and hold strategy, which oftentimes is your new ground up, new development type opportunities. Am I saying that correct?
Yeah, absolutely. I mean, 95% of my net worth is in those strategies that you've just described. I'm happy with having my capital be churned, every 2 to 5 years, making a 2.0 multiple, essentially doubling my money every 5 years, and then essentially reinvesting it right back in, so that I'm not, paying all those capital, or deferring those capital gains taxes indefinitely. To me, that's the same as uninterrupted compound interest. That's the same to me as essentially, buying a property and holding on to it. It's just, I'm probably going to get a higher return on my equity by churning my capital every 2 to 5 years. Let me explain how that works. So you've got like a regular rental property that's going up in value every year. So your equity is increasing, and the amount of cash flow that you're getting every year, as a percentage of the equity you have in the deal, it goes down every year because the value of the property keeps going up. And so at some point you need to, pull some of that equity out and reinvest it in other stuff, so that the percentage of cash flow that you're getting, your cash on cash, as a percentage of the equity that you have, can go higher. And so we do this with two different ways, and we call these transactions. They can either be a refinance event or a sale. And so they're both good. However, in the refinance situation, you're so constrained by what the bank will allow you to do. Right now, you're getting a 50 or a 60% loan to value, and you're probably not pulling much cash out, and the interest rate's going to be high. And so there won't really be much cash flow there, and you'll still have a ton of equity stuck in that property, as opposed to what I'm doing, which is, selling assets, taking all of my equity out and then putting it right back in to something that's going to maintain my cash on cash or my return on equity, for the next, 2 to 5 years.
That's great. Thank you. So I have a question for you, Elijah, and that is, you've had this great track record of investing passively as a limited partner. Obviously, you're encouraging through your network other investors to partner with you. But has it always been rosy for you? I mean, have there been any investments that you've been involved with in the past that maybe haven't gone, as planned?
So, nothing's been rosy. None of them have gone as planned. They've all been tremendous headaches, and they've all been, at some points, horrible experiences. But every single deal that we've done, we've been able to exit at, much higher IRR rate of return than we had projected. And so that's, those who take the risk will get rewarded. And so we've been able to invest during a very hot market, and we got rewarded for taking that risk. But it was all very rocky, tumultuous experience.
Just to clarify, the rockiness has been on the investments that you were involved with on the active side. Am I saying
That's
that
right?
correct?
That's right. What's so great about being a passive investor is that you're not always privy to all the day-to-day fire drills that occur at the property level. Whereas, I still have an active portfolio that I'm working on selling. And, I got a call last week that there was a flood and we had to renovate 2 units because of that, and call our insurance. And it's like the amount of time that sucks up and the amount of brain power and anxiety that it causes me. It's just it's total headache. Now, granted, I'm going to be making, maybe 100% or more maybe a 500% rate of return on my money on that deal because I'm the one doing the work. But, I am so willing to give up like most of that rate of return to not have to do the work. So I'm happy taking a 15 or a 20% rate of return if I don't have to do anything.
Yeah. It's one of the kind of defining moments of my active to passive journey as well, was when I was fixing and flipping homes. I was making decent income on it.
Yeah.
However, with going from 2 to 4 kids at the same time, kids actively involved in sports, spending evenings and weekends, at the property, kind of the camel that broke the straw that broke the camel's back, so to speak, was when we were looking to get out of an asset that we had renovated. And the inspector told us that the septic system had failed and needed to be completely replaced. Okay. Wow. So there went all the profit, that we were going to achieve on that asset. So that was kind of the pivoting moment from us. So I appreciate that. So kind of the last thing I want to ask you, I'm going to hit you with a few questions. Sure. All right. As we kind of wrap up here in rapid succession. I call this, let's get straight to the point. Okay. So I'm going to hit you with 4 or 5 questions. Go ahead and give your best, quick answer, and then we'll wrap it up. All right.
Sure.
All right. So my first question is what is one purchase or investment you made that you've since regretted? We may have already answered that, but are there any others, whether in real estate or outside of real estate?
Yeah, I bought a bunch of Bitcoin and Ethereum like last year at the very, very top, and have since lost 50% of its value.
Yeah, I don't think that you're alone in that regard. A lot of folks on this, I've had investors tell me before that the main reason why they don't have enough cash on the sidelines to get into the real estate game passively is because they lost their short, so to speak, in the crypto space.
It's funny, every time I go out of real estate, it loses money. So.
So my next question is, and we might already know the answer to this based on that last response, but if you had an extra $1 million in cash sitting on the sidelines, where would you put it?
Yeah, for me, this is really simple. I would, allocate it in $100,000 chunks to 10 different syndication deals. Probably deals that I am also raising a special purpose entity fund of funds for.
Great. I'll have you on another subsequent episode to explain to my audience the difference between a fund of funds
Mhm.
or SPV
Yeah,
versus the traditional co-GP, co-LP.
sure.
So thank you. What are one or two ways that you use your talents to give back?
So I really believe in, education and financial literacy. It's not taught in schools, and not only is it like important for everybody to know this, but it also creates a lot of leads. And so I go on LinkedIn. I post 3 to 4 times a week. I love to write, and I usually write something educational or a lesson that I learned, money that I lost doing something and what I learned from it, or a case study of something that went right and what I learned from it. And the goal is to just essentially help people become better multifamily investors.
Yeah, that's great. I've found myself to be somewhat of a magnet when I am transparent with others about investing mistakes that I've made in the
Oh,
past.
yeah. They love it. They
And what
feed off of the lost money. They love it.
That's right. That's right. So thank you. What is one or two favorite books or podcasts other than the Freedom Point Real Estate podcast that you would recommend to the audience?
Well, right now I'm reading Leadership Strategy and Tactics by Jocko Willink. Now, I am in the U.S. Army. I'm in the reserves, and so that language kind of speaks to me more. But it's great for anyone who's interested in being a leader or being an entrepreneur and running a business. Obviously, most people here have probably heard of Rich Dad Poor Dad. That's like where you start. I read that when I was 12 and made a decision right then and there that I was going to become a wealthy investor. And so that's definitely a good starting point.
Do you have any book recommendations that you give to the passive investor? I know Jocko Willett, big fan of his, obviously
Yeah.
the Purple Book, right? But are there any specific books that you would recommend to a passive investor if they wanted to learn more?
I love it when people ask me this question because my answer is stop reading books and go do a deal because you're going to learn so much more. They have these $30,000 courses and there's like all these books. You can go buy every single book on the Bigger Pockets lineup and read it all. Spend 2 weeks reading it all, and then you'll have a good baseline understanding. And you still won't know 10% of what you'll learn from doing an actual deal. So that's what I say. Just go out and do a deal.
Yeah, fair enough. I totally agree with you. I think a lot of times people tend to get, analysis paralysis or paralysis by analysis, whatever you want to call it. But there's one book that I like to recommend. I'm sure you've probably read it before and maybe, you've recommended it. It's called The Hands-Off Investor by Brian Burke.
Nope.
Huge fan of that book. Well, you could throw it on your bucket list.
I will.
Yeah, great book. I highly recommend it, especially to that, new passive investor that's not yet invested passively into a real estate syndication. I think that book just does a tremendous job, really breaking down all the different facets of a real estate syndication, how the process works, how the sponsor makes money, how the investor makes money, all the various different obstacles, that the sponsor has to overcome, during that value add, business plan. So anyways, good shout out there. My last question is, Elijah Brown. I didn't say your last name at the beginning. Elijah Brown. All right. How can our audience learn more about you and to connect with you?
Yeah, the best way is add me on LinkedIn, linkedin.com/in/Elijah W. Brown. Shoot me a message. You can download my free ebook, which is essentially a guide on how to become a multifamily passive investor. And all those links are, in my profile on LinkedIn. You can also check us out on GoldHawk.us. That's our company's website.
Elijah, you've been awesome. Thank you for providing my audience with so much value today.
Thanks so much for having me on. It was great. Appreciate it.
And listening audience, thank you again for joining this episode of the Freedom Point Real Estate Podcast. Look forward to catching up with you on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.